Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the week ending January 15, 2021. So, this week I will be going solo. Our chief economist, Clément Gignac, has a scheduling conflict, so we won't be able to make it. But before I get started, just an announcement. As many of you have noticed, because we've had lots of email, now due to the new accessibility rules that IA complies to, we can't put the PDF anymore on the ia.ca/economy webpage. You can always, if you are a representative of IA, you can access it on the intranet. And don't ask me exactly where or how. Maybe you should ask your representative, but I know that it has been taken on the intranet. It just can't be on the web page. And if you can't access it, well, temporarily at least, you can always write at economics@ia.ca, and we'll make sure to send you a copy of the PDF. So again, this because of compliance to the new accessibility rules is something that's beyond our control. So the video will be there, but the PDFs won't be publicly available anymore on the web page. So look at this week's markets review, this week's markets activity at the close on a Thursday. So another negative week for bonds. So minus 0.71% for the long index, minus 0.26% for the universe index. So year to date between minus 0.6 and minus 3.3% for bonds. So of course interest rates rising are explaining that. So not short rates but longer rates. I'll discuss that in a few minutes. But you have a strong headwind if you are invested in bonds currently with rising interest rates. Equities, you can see a theme here. Emerging markets, EFI, so Europe and Asia are doing well. Year to date, they're doing quite well. In fact, emerging markets, they had a strong end to last year, and after only 2 weeks in 2021, already up 6.4% in local currencies and 5.5% in Canadian currency. So strong momentum there. Of course, they underperformed the U.S. market for so long that now we were seeing higher rates, stimulus, global economy doing well. So it's supporting emerging, it's supporting EFI, and it's also supporting the TSX, which are all outperforming the US indices year to date. Price of oil up 2.5% on the week, 10.4% year to date. The Canadian dollar followed suit, up about 0.5% this week. So we're now at 79 cents. We would not be surprised to see 83 to 85 cents this year with the global recovery going on. Euro was strong in the end of 2020 versus the USD, now taking a little bit of a pause, but still very healthy, 122 here. And the price of gold quite volatile and down 2.7% year to date so far. So COVID, an update on the situation. So not much new here. We've had the kind of the rebound of cases following the Christmas vacation, but now in Europe and Canada and also in parts of the US, we're seeing more lockdowns. So this is helping. You're seeing a drawdown in cases. So of course now the focus is on the vaccination campaign. Let's hope that we'll get more good news than bad news in the following weeks and months. But we think that with the vaccination campaign, maybe we're looking at something that starts to look like a peak, or at least let's hope so. But this is still something that we need to live with, the COVID. When you look at the economic situation in the US, well, the labor market is clearly headed the wrong way. First part of 2020, you had lots of job losses. Then after that, a strong rebound, then a cooling off. But now we're negative. So we discussed that last week, minus 140,000 in December, not going the right way. On the right side, you have the unemployment rate, which went from about 3.5, 3.6 before COVID, jumped all the way to 15%. Now we're back to 6.7%. But as you can see, the move down has now tapered off, and we're moving sideways. So let's hope that we don't start climbing again, because yesterday on Thursday morning we had the jobless claims, the initial jobless claims, so the new people asking for employment insurance, and it was actually growing quite rapidly and at the highest level since March of 2020. So it's not going the right way. So let's hope that the stimulus that is coming in Washington will help. And talking about that, well, this week in Washington, which is kind of soap opera that we have now. So first part, the second impeachment of Mr. Trump. So I won't be commenting that, of course, but Mr. Trump's terms should end in the 5 days. So, it's so the impeachment should be the trial should be after the end of his term. So this is kind of on the sideways now, but the sidewalk, rather. Um, Mr. Biden, though, yesterday announced his new COVID stimulus plan, so another stimulus. So a few weeks ago, we had $900 billion of stimulus announced in the US, which was about 4 or 5% of GDP. Now, Mr. Biden is proposing to put on top of that 1.9 trillion, which is another 9% of GDP. So you start to be at about 25% of the GDP in the US in stimulus. So that's quite a lot of money. So checks to households, rise in federal minimum wage. So that could be inflationary at some point. That should be inflationary at some point. So the market reaction this morning was actually a bit negative because the market was kind of doubting that it would go, all of that plan would go through Congress and Senate because some Democrats in Senate or in the Senate are already barking at that and saying, well, maybe it's too expensive, it's too much. So we'll see what goes through. But the US economy needs stimulus, and Mr. Biden wants to make that first priority to kickstart the US economy. So let's see if it helps regain some momentum. In Canada, also, we're still losing momentum because of the measures that we put in place for this new wave of COVID and the lockdowns. Of course, as I mentioned last week, on the left you have the job losses. So we lost 62,000 jobs, 62,000 jobs in December of 2020. Let's hope that it's only because of the confinement measure and we don't start to have a few negative months back to back. On the right, the recovery tracker. So here many parts of the economy. It's an index that was built by Oxford Economics. So you have the financial part, the sentiment, the activity, the part that is linked to US activity, employment, mobility, health. So all of these components are plotted here. As you can see, we're losing some steam in pretty much all of these components. So we are hitting a bump in the road. So let's see if vaccination campaign helps us reopen and regain the momentum that we had so strong in Q3 and Q4 in Canada. Financial markets now, yield curve keeps steepening, as I mentioned earlier. Central banks are keeping low short rates very low, so the long part is rising. So of course, everyone is looking at all of that stimulus, the reopening of the economy that should take place after the vaccination or during the vaccination campaign, and everyone says, well, there'll be more growth and there'll be more inflation, so that means higher interest rates. So that's why we have this steepening, which is accelerating quite strongly in so far in 2021 after only 2 weeks, but still. So we're now at have 100 basis points on the yield curve between the 10-year and the 2-year in the US. This is the left-hand chart. On the right, you see that also in Canada, the 30-year bond yield is rising quite sharply from 120 to 146%. So quite a rebound there. So that's a headwind for the bond market, but it's also helping the rotation in equities because higher interest rates means that usually that's good for cyclicals, and that's good for the financials, for insurers. So the names that were out of favor in 2020 are becoming in favor so far. But still, when you look at the stock market now, we're starting to see signs of euphoria, and it's not because the market is euphoric that it can be euphoric after that. So it's not a sign of imminent trouble, but usually when you have so much euphoria, it tends to end bad. So that's why we start to want to start to show you things that we see that make us more careful. So we still like equities over bonds, okay? We still think that we're going to have a positive year for equities, but we think that in the short term, it's better to be more and more neutral, more defensive, maybe wait for a better entry point. And when we have another entry point, well, it will be a good time to deploy cash. But right now, being heavily invested in the stuff that is the most speculative parts of the market, probably you could be asking for trouble. On the left, you have the daily volume of the NASDAQ divided by the volume on the NYSE, the New York Stock Exchange. You can see it's looking like a rocket shooting for Mars now. On the right, the technology sector, the total market cap of negative earning IT firms. Many IT firms have negative earnings because they have to reinvest so much of the revenues that they make. It's normal, we see that. But the total market cap now of these firms is well above what it was at the height of the dot-com bubble. So it makes us more careful with what we buy and where we invested the money. The most speculative parts of the market might be frothy to say the least. Bets to the upside also at all-time high. So here we're looking at options. On the left, you see call options. So call option, you pay a small premium and it's a bet that the market will go up. So the volume on call options, as you can see, used to be in a pretty tight range between 2008 and 2020, but now it's broken up out of its range and it's about 25,000 when the range was about 10,000 before. So that's quite a breakout. On the right is the ratio of the volume that goes into put options. So when you buy protection, so you kind of make a bet, you buy an option and you win if the market falls. So the ratio between the two now between put options and call options, which call options is you make a bet that the market will go higher. The ratio between the two is back to pretty much where it was at the end of the dot-com bubble. So also not a good company here. Maybe there's lots of euphoria in the market and lots of speculative activity. So that doesn't mean that it can be more speculative even, but it gives you an environment that if you're a long-term investor, very good profits that were made in 2020 could be taken, put to cash and wait. But this is the kind of strategy that we did. We were strongly overweight equities, strongly underweight bonds. Now we're lowering the overweight in equities, which in some funds is very close to zero now, neutral, and we put the profits in cash, and we are waiting to be able to spend the cash to when we have a better entry point into the market. Another indicator here, IPO, so initial public offerings, and penny stocks in high demand, so echoes of 1999. So on the left, you see a few news. A handful of penny stocks made up a fifth of the U.S. volume for one day on Monday. So that's quite unusual. And online clothing reseller Poshmark. I didn't know that company before I saw the news. They sell used clothes online, is my understanding. And their first day of trading up 140%. So that tells you that there's lots of appetite for anything that's speculative. And on the right, you see an index of the Renaissance IPO index over the S&P 500. The black line is now, and the red line is between 1995 and 1999. So you can see the recent behavior of that's pretty much exactly the same as it was between 1995 and 1999. So we're seeing the same kind of speculative activity now that we had the dot-com bubble. So are we near a market event or no? You never know. You never know in the short term. But what we know through history is that when we see that, at some point it doesn't end well. So we'll see where we end up. So what to watch next week in Canada? Housing starts, inflation. We'll have the Bank of Canada's rate decision. Consensus is for no change. We'll have retail sales. Last month we had a gain. We'll see if we still have a gain. This will be the November figures. In the US, housing starts and building permits are healthy. 1.6 million units is a very good number. Market manufacturing PMI, so kind of a preview of the ISM index that will be available in 2 or 3 weeks, so should be stable at the healthy level of 56.5, and existing home sales should be also pretty good at 6.6 million in December. So that wraps it up for the week. ia.ca/economy is your go-to webpage. You can subscribe if it's not done already. The replays of these videos will be there. As I mentioned, the PDFs are not because of the accessibility rules now. So if you need them, as I said, contact your representative or send us an email. And for we won't do that permanently, but for a while, just to accommodate economics at ia.ca, we can send the PDFs out. So that's it for this week. I wish you a very good week, and we'll be back again next Friday with another edition of the Weekly Economic Review.